When we talk about investing in AI, our minds pretty much instantly jump to companies like NVIDIA, right? AMD, Micron. It feels like the whole game is about who has the fastest chips and the smartest models. But what if that's not the whole picture? What if the real bottleneck, and maybe the real opportunity, is hiding in plain sight?
Okay, so let's break this down. Right now, pretty much all the conversation, all the hype is focused on AI models and chips. But all that amazing tech has to run on something, and it's all being squeezed through this very real, very physical bottleneck: power. And not just the electricity itself, but the entire infrastructure needed to get it where it needs to go.
So here's what we're going to cover in this explainer. First, we'll dig into a popular misconception about how AI is going to grow. Then we'll introduce this really interesting idea called the Follow the Watts thesis and look at the companies it points to. After that, of course, we've got to talk about the risks. And finally, we'll wrap it all up with a new way to think about the entire AI landscape.
All right, first up, this big misconception. You see, everyone's so focused on the software and the silicon that they're missing a fundamental truth. All this AI computation, it is incredibly hungry for energy, and that energy has to come from somewhere.
And listen, this isn't just some abstract theory. The tech giants themselves are talking about this. This quote just nails it. On recent earnings calls, you had companies like Meta and Microsoft saying, hey, demand for our AI is through the roof, but then they admit they can't scale up fast enough. And the problem isn't their software. The problem is they literally can't get enough power and infrastructure to run the machines.
So, if power is the constraint, how do you find value there? Well, this brings us to this fascinating investment thesis called Follow the Watts. The idea is pretty simple. Stop chasing the latest, greatest AI model and instead focus on the concrete, tangible stuff that makes it all run. At its core, the whole thesis is just this. The real scarcity in the AI boom isn't code or chips, it's kilowatts. It argues that the companies who control the power and the facilities that deliver that power are sitting in an unbelievably strong position.
So let's walk through the logic here, because it's actually pretty straightforward. Step 1, AI needs a truly immense amount of electricity. We know that. Step 2, you can't just build power plants and data centers overnight. This stuff takes years of planning, permits, and construction. That means, step 3, the companies that got started early have already locked in access to power. And that leads to the final step: they've built a powerful competitive advantage, what investors call an economic moat, that's just incredibly difficult for anyone else to get across.
Okay, so if we're going to follow the Watts, who are we actually following? Well, the thesis points to a handful of companies that are, in a very real sense, building the physical foundation of the entire AI revolution.
Let's run through the watch list here. You've got companies like Applied Digital, which has these huge data center campuses where, and this is the key part, the power is already secured. Then there's TeraWulf, who's a strategic partner with Google. You see Cipher Mining, which has what's called multi-hyperscaler optionality, which is just a fancy way of saying they're not tied to just one big tech company. You've also got Riot Platforms with its massive footprint in Texas, which has a ton of power, and others like Iron are getting creative, leasing out GPU cloud capacity to monetize the power they already have. You can see they're all coming at this from slightly different angles.
And this is really the heart of the argument. According to this thesis, these 7 companies, together, are holding an estimated $85 billion in contracted infrastructure revenue. And let me be clear about what that means. This isn't just a guess about future growth. This is supposedly real revenue from major cloud providers locked into long-term deals.
Now hold on, before anyone gets too excited, we have to be really clear about something. This is not some guaranteed, risk-free strategy. Not at all. We're talking about an early-stage idea here, and that comes with some pretty big potential problems.
And those potential headwinds are serious. First, there's just execution risk. I mean, building this much stuff is hard, and delays can and do happen. There's also counterparty risk. You're betting that these big tech partners are actually going to follow through on these massive contracts. The market could also just keep undervaluing these companies. And you have to think about tech shifts, right? What if new AI models come out that are way more power efficient? And finally, you've got red tape. Regulatory delays can slow everything to a crawl.
So when you put it all together, what the Follow the Watts thesis really gives us is a totally different way to look at the AI boom. It forces us to think about it from the ground up, literally.
So at the end of the day, what's the big takeaway here? It's that the AI revolution runs on power. The flashy stuff we see, the apps and the models, that's just the tip of the iceberg. The whole thing is built on this massive physical foundation of electricity and infrastructure. And right now, that foundation is becoming the scarcest resource of all. The companies that control it might just have a unique advantage that the market hasn't fully woken up to yet.
Which leaves us with a final, really interesting question to think about. You know, back in the gold rush, the people who made the most reliable fortunes weren't the ones digging for gold. It was the people selling the picks and shovels. So in this new AI gold rush, who's going to be the real winner? The people selling the code or the people selling the power?